Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
All right, so let's add in trends. So now we've kind of figured out where resistance is and where support is. And what we teach in our core strategy is how to identify those areas on any time frame, depending on your trading style. And then we combine that with trends. So just the regular definition of a trend is, for an uptrend, it's a series of higher highs and higher lows, which is a bull market. And in a downtrend, you have a series of lower highs and lower lows, which is a bear. And then we also like to say that there's different types of trends, which are trends that are inside of different types of trends. You can have what we call cyclical bull market rallies in secular bears. You can have secular bull markets, and you can have bear market rallies. So you have to figure out a way to identify which trend you're going to trade. If you're going to be a long-term trader, you're probably going to trade what we call the primary trend, which usually lasts for several years. And this is the trend that usually takes place on the higher time frame charts, such as the monthly and the weekly charts. If you want to be a more active trader, you can trade what we call the intermediate term trend, which is usually profit taking, which is counter to the primary trend. This can last for sometimes days or weeks. You can see these types of trends on daily charts, 4-hour charts, or 60-minute charts. And if you want to be a short-term trader, you can trade the intraday trends on smaller time frame charts. The current trends that we have, the secular bear market that we've had several of them. This is actually thought to be a secular bear market in the Dow Jones, which is expected to last about as long as the secular bull market did. So the secular bull market went from 82 to 2000, which is 18 years. And so there are technical analysts that are projecting that we're going to have a secular bear market that lasts from 2000 to possibly 2018 or 2020. We also had a bear market in the gold market from 1980 to 1999, and as you can see right now, in 2000, gold started a bull market, and so far it's 2011, and it's projected that that gold bull market could last possibly into 2019, 2020. Now remember this though, we had a similar rally like we're having right now in the stock market in around the era around the Depression. We had about a 30% rally after a 45% loss. And then the Dow turned around and lost 80% before it finally hit its final bottom. Now, if that type of technical analysis works for you, then you'll probably enjoy Elliott Wave and other Gann or Gartley, other projections of where they think the market's going to go based on those long-term trends. I prefer to trade the cyclical trends. The cyclical trends are related to the business cycle, the economic cycle. The economy has the expansion, peak, contraction, trough, and the stock market, the bond market, the currency markets, the gold, every one of these markets, commodities markets, has an accumulation phase followed by an uptrend, followed by a distribution phase, followed by a downtrend. So that type of trade follows along with the business cycle, except that most of the time, depending on the asset, it can lead the business cycle sometimes by as much as 6 to 9 months. And if it's a stock market that you're trading, then you're going to want to watch the transportation sector, the technology sector, services sectors, capital market sectors, because these are the sectors of the market where the big money is going to put money to work based on this economic cycle. And of course, the stock market made a big turn in 2009, and right now, I would probably say we're at the trough down here in the economy. So if you were waiting for the economy to turn and the news to get good, you've already missed a substantial 100% rally off those prior market lows. So what you want to do is you want to watch your market, trading either in a sideways channel or in an uptrend or a downtrend. And if you see the market trading in a sideways channel and it breaks out to the upside, this is when you begin a new bull market. When you begin a new bull market, it's not going to feel good. The news is not going to be good. Everything is going to make you think that it's just a false breakout and you're eventually going to make new lows. And there's always the possibility that that could happen, which is why we always want to use a stop loss. But my rules say once the market breaks out of a channel to the upside, it begins what I call a stage 2 bull market or rally. And the primary trend at that point becomes up. And now the intermediate term trend can be either up some days or it can be down. It can be in the opposite direction. However, because I have determined this to be a bull market, I am switching up from selling rallies to doing something called buying the dips, buying the retracements. And I'll usually use some kind of a trend line to do this or a moving average. And this is how we teach you to stay with that trend as long as you possibly can. Eventually, though, the market's going to get to a point where it channels once again sideways. And usually by this time, the news is starting to be good and investors are starting to become confident again. But the pros who bought low are going to sell high to the novices who usually buy high and then unfortunately end up selling lower. And if the market does break out of a channel to the downside, it will begin the next trending phase, which we call at this point the stage 4 decline, where the primary trend is down and you should actually be selling the rallies. However, you're going to be hearing on the news that this pullback is a wonderful buying opportunity. But I'll tell you folks, most of the time the people telling you to go ahead and buy are looking for you to buy so that they can sell. So this is, again, a secular bear market in the dollar ever since the 2000 area, all the way down to where we currently are. But during that time, we had a cyclical bull market rally in this longer-term secular bear. And we had several of these. The dollar's been stuck in a channel between about 75 and 90, the index, for going on 3 years now. So your rules for trading using support and resistance and trends is basically if price is near support, the current downtrend always has the potential to stall. So in other words, the vertical movement that the market is going through at least has the potential to stall at that point. Same thing if there's an uptrend and price is nearing some kind of price resistance. That's when the current uptrend has the potential to stall. If you see that the market is in a stage 2 uptrend, you can buy either by buying when price makes a new high or buying when price retraces to either a vertical or some kind of horizontal support. So if the market is in a stage 4 downtrend, you should be looking to sell the rallies, and you can either sell the rallies or sell when price makes a new low. And of course, that's a function of your trader personality. Because if you're going to be buying when price makes new highs, you're going to be buying strength. You're going to be buying when the market is rallying. You're going to buy momentum. You can call it anything you want to call it. But you have to have the personality that allows you to buy when price is breaking past resistance. If you're going to be buying when prices are pulling back to support, you're going to be buying weakness. And a lot of times you're going to think to yourself, why would I want to buy anything that is going down? Well, buying something that's going down in an uptrend is the only other way that you can buy if you don't like to buy new highs. If there's a downtrend, you're going to be selling when price makes new lows, when it breaks through some kind of support, which is called selling weakness. Or you can go ahead and you can sell when markets rally into some kind of resistance, which is selling strength. So on the dollar futures contract, in a bull market from last year, I have a pullback to support on my moving averages, which we'll talk about in a little bit. Or I could buy when price broke out and made new highs. Here's a couple of times where prices broke out and they made new highs. And of course, in a bear market, when price breaks through some kind of price support, when it breaks through your moving averages, when it breaks through the bottom of a previous weekly channel, then you could go ahead and sell weakness. Or when price comes down to some kind of support and then bounces up, in this case to my downsloping moving averages or my trend line, then I can sell the new lows or sell the rallies, which is also, you'll hear people say, sell the rips. If you're a position trader, if you're somebody that's going to buy and hold while it makes sense because the market is in a bull market, and buy and hold does work in a bull market, then you're going to probably try to buy as soon as the breakout happens down here and hang on as long as you can by trailing your stop loss below this trend line. And when the market finally decides that it's going to top and drop, that would be where you as a position trader would want to exit. Now, if you're a long-only position trader, then you're probably going to wait for the next stage 1 accumulation down here, followed by the next stage 2 uptrend. But if you're somebody that takes a class or learns how to short, then you have the opportunity to become what we call a swing trader. And a swing trader is basically going to look to trade when price is inside of a channel, long near support, short near resistance. Once price breaks out into an uptrend, they can use prior areas of resistance for profit targets. They can also use prior areas of price resistance to initiate hedges on their trades. If you're an option trader, be a perfect time to sell the calls, and of course, hang on to your longer term position. It's almost like covered calls. Once the market gets to a point where you have a distribution, a trading range that eventually breaks out to the downside, now we know it's a distribution. At that point in time, you can sell the rallies. You can also sell when price makes new lows. Once you've determined that the market is in some kind of a trending phase, once again, versus a channeling trade. And as a channel trader, either on the higher channel or the lower channel, you can go long and short. So depending on your trading style, you will be trading a trend. But now, the question is, am I trading with or against the primary trend? And most of the time when traders lose, it's because they do not trade with the dominant trend of the market. So if you were somebody that was shorting the rallies and the spiders and shorting the rallies and the euros for the last few months, you've experienced quite a bit of pain. You've had the opportunity to trade the intermediate term trend provided you were trading the profits and taking your profits when you were doing it. But if you were looking for market reversals every time you ran up against some resistance, it didn't happen. And therefore, the primary trend, which is still up in this case in both markets, was reasserting itself, and the market was continuing in the upward fashion. So since we have several markets near prior turning points at the same time, the last time this happened was in March of 2009, which only means that the markets do not usually go from bull to bear directly in most cases. Back in 2009, the NASDAQ bottomed in 2008 and retested it in 2009. So we had an M-shape reversal. But the spiders and the diamonds, the Dow, actually made a V-shape reversal. So the NASDAQ, though, was definitely channeling from 2008 November till 2009 of March. So these areas where we're at right now, the support for the dollar and the resistance for the stock market, could be the beginning of a stage 3 top or a stage 1 accumulation for the dollar. And the reason I say that is because I use weekly charts. So I'm looking for this whole sideways process to take a long time to finally work its way through. And remember, if they take out all the buy orders, prices will go lower. If they take out all the sell orders in these markets, then both markets will go higher. So with multiple markets near prior resistance and support areas, you can look for certain fear and greed chart patterns to form. At market tops, you usually see double tops, triple tops, head and shoulders. At the market bottoms, you're going to see popular chart patterns such as double bottoms, triple bottoms, rounded bottoms, inverted head and shoulders. As the market moves, a lot of times you're going to see what we call ascending triangles and descending triangles. And you know, one of the things I've noticed from technical analysis over the years is a chart pattern that was considered to be only a reversal pattern may occur during a move. So you may see an ascending triangle or a descending triangle at a market top or a market bottom. But remember, chart patterns are notorious for being subjective. So here's a double top, and this happens to be our dollar versus the euro. Now, certain technicians will say this is not a double top because there's too many visits up here. You'll say that this was a double top here and this was a separate double top. Or other technicians will look and say, well, both tops actually occurred at the same time in the same area, so this is a double top. But one thing for sure, this absolutely huge trading range that we had from here to here and from here back again down to here is an indication of the public finally becoming interested in the market, almost as bad as that silver market we looked at. In the British pound, last year we had a shoulder and a head begin to form in May. We completed the head in June. Eventually we completed the right shoulder around August and September. And then from there we actually broke through and completed the pattern. So this head and shoulders took many, many months of sideways trading, followed by a head, followed by more sideways trading, and then finally a break of the neckline. And at that point in time, if you measure from the top of the head to the neckline and project your profits, you finally reached your objective in this chart pattern. Here we have almost a triple top pattern. We have multiple visits up here with the dollar versus the Canadian dollar before the market finally tops out. And here we have a symmetrical triangle pattern with a highly volatile trading range. And of course, we have lower highs and we have higher lows. So this was an indecision triangle, which could have broke out in either direction. Now, head and shoulders, double tops, a lot of these patterns can fail, and they do fail. And sometimes price will just extend, make new highs, and then retrace itself back inside of a trading range, which leads to a false breakout. And sometimes those false breakouts lead into large moves in the opposite direction. But of course, if you're insisting that the market has to make the double top or it has to make the double bottom, then you're possibly going to be fighting the market when it does make that reversal and break through that chart pattern. So just recently we had in the NASDAQ QQQ, the NASDAQ 100, a left shoulder, a head, and a right shoulder. But a few weeks later we were breaking through, and it's another broken head and shoulders pattern. We never broke through the neckline. And if I would have drawn my neckline in a different place, I may have actually been short on a break of that support. So you have to have some kind of a rule so that you're not stuck with this head and shoulders once it fails. If it crosses back above where the high of the head is, the market wants to go higher. Here we have a potential double bottom, which is one of the bottoming patterns that we see in the market. And then we have another double bottom in a different currency. This is the dollar versus the Australian dollar. And at this point in time, it actually turned into a potential triple bottom. It held support, it rallied a little, it came back down to test the support again. However, there's a failed triple bottom. And once we broke through those lows, those prior lows just below 100, the market made another large move lower. So these failed chart patterns sometimes lead to large moves in the opposite direction. Now, when I look at this one, I can make the case for what we call the inverted head and shoulders. And the reason is because we have a little basing for a left shoulder. We have a lower area, which becomes our head. And then we begin to base again near where the left shoulder was, which forms the right shoulder. At this point, if you measure from the bottom of the head to where the neckline is, where the breakout happens, you can project your potential target. And this is the textbook way to trade an inverted head and shoulders. But sometimes those patterns for one trader will look like a head and shoulders. For another trader, they may notice that on that last chart pattern, I kept making higher lows. And if I keep making higher lows and I'm holding the resistance area, that's what an ascending triangle looks like. Now this is a pattern that's normally associated with continuation. Same thing with a descending triangle. However, if I see that same pattern at the bottom of my chart, it is a sign that institutions are buying on dips and beginning to accumulate this asset in anticipation of a breakout for higher prices. So if I don't see an inverted head and shoulders, but I do see a market that is making higher lows on each one of the sell-offs and just about to break through this resistance, then I can say that this looks like a market that's been accumulated for a move higher. And the same market actually went a little bit higher and formed another continuation pattern called the potential bull flag. Of course, for a bull flag to succeed, the market would have to break out to the upside, and if it breaks out to the upside, you would once again look for some area of resistance above current price to project for a target. And always trail your stop loss below the low of the flag once the breakout happens. In this case, the market broke out sharply to the upside. It rallied from the breakout point at around 140 to about 150, or a little higher, and then it failed again. So the market was going through some wild gyrations last year based on some economic data that was coming out and bad news out of the Eurozone, and the dollar was getting quite a nice bounce for the early part of the year. So once again, if I think about the four stages that I've just talked about, if I have an ascending triangle at the bottom of my chart and I break out into a new uptrend, and all of a sudden I have some kind of a pullback, as in the case of that bull flag, and it becomes a buying opportunity, or if I buy the breakout of the bull flag, I'm trading this uptrend. But remember, this uptrend can and will sometimes fail, and sometimes quickly fail. So always trail your stop loss just below the low, what we call the pivot low or the previous week's low. Or if it happens to be a little bit of a longer time frame chart, sometimes you can use the last test of a trend line to put your stop loss. If the market happens to go higher and once again bases and breaks out to the upside, you now have a higher stage one accumulation and a new uptrend.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX Options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.